Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, they would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 149. As always, joined by the three amigos, Boomer, Keith Dicker, IceCap Asset Management, Rich Diaz. Welcome back to the show. Boomer, what's up? What's new?
Man, 149 episodes. So we have, I have some corporate news to share with everyone. We don't do that very often on the podcast. But
Drum roll.
Drum roll. For 149 weeks straight, I've developed a real nice relationship and friendship with Rich. And absolutely thrilled today to share with everyone that Rich has now joined IceCap Asset Management. So Rich and I are going to be working together going forward. We've been talking about it for a while, but I'm just so happy and excited to have Rich come on board. And he makes our business is already having a lot of success, but I know this is going to make us even stronger. So everyone, whether, take it, it's a great story here. But Rich, welcome aboard, my man. Excited to work with you.
Thank you, Keith. I'm super excited to work with you. It's been a long time coming, I think. And I think it's going to be really fun. I think we're going to have a lot of success together. I think we're a good sort of counter to one another in the way we think about the world, which is only going to be for the best. It's going to be help our clients. It's going to help the way we think about things. We're going to have some fun. We're going to drive Steve a little crazy, but that's okay. I think.
Where the hell's my job offer?
Yeah, I think after 300 episodes, IceCap.
Yeah, exactly.
It's real estate development.
Yeah. You guys want to come over here? We'll start a pre-sale team.
No, but I'm really excited because Keith, you've been a mentor and a friend, and I think I have a lot to learn from you. And I think it's just sort of the evolution of my career. And I think I'm excited. I think we're going to do some great things. I think we're going to have a lot of fun, and hopefully our clients will really be the main beneficiary of this next chapter for me.
Rich is a free man. He doesn't have to worry about Frank breathing down his neck now from from compliance.
Oh, so and most important. Sorry, go ahead.
Yeah, any fun emails or phone calls, you call me. Anything else, just call Rich. That's it.
Most importantly, I have the appropriate uniform, which is I bought a Patagonia shirt just for you, Keith.
Okay, we're on
the right side commitment. Here. I want to demonstrate my commitment to IceCap. So there you go. All right, here we go.
Okay, Steve, what's happening? What's happening on your side?
Episode 149. More importantly, next week is 150. And we've got a fun guest next week. Just mark this on your calendars. We've got Mike Moffat, economist, Professor Mike Moffat. He's done a lot of research on Canada's housing woes, particularly around the supply side. He's done a ton of data on the immigration front as well. He's been in the room with Mgmt. So he's a pretty well connected guy, and he's built a very large following on Twitter. So and I think he's pretty straight down the middle in terms of just putting out good information and trying to keep the politics out of it. So we're looking forward to having him on the show, but we'll get into that because there's a lot to touch on, Rich, from the immigration side. There's been a lot of headlines this week around what's going on with Canada's immigration problems. And, managed to have a conversation with Mark Miller a couple months ago, and he's, oh well, we're going to tackle this, and so we had the UN out recently saying that Canada's temporary foreign worker program was the sort of modern equivalent to basically modern slavery. Basically, people are coming here, paying for temporary work visas in order to hopefully to get at some point a PR, and being paid, bare bones. And so there's been a lot of unrest about this because over the last couple of years, the temporary foreign worker program has nearly doubled. So the position size has nearly doubled. And what we're seeing is that's actually end up replacing a lot of Canadian jobs. It's particularly amongst the youth, right? If you think about a temporary foreign worker coming in, let's say getting hired at Tim Hortons, that's a job that a 17-year-old Canadian could have had. And so we see youth unemployment in Canada right now. It's the high outside the pandemic, of course. It's the highest it's been since 2009. So essentially it's at a 15-year high for youth unemployment. So Rich, I mean, there's lots to chime in here, but I'll leave it over to you.
Yeah, I'm just well in general, youth unemployment is almost always higher than the unemployment for the rest of the economy. It's important people sort of know that. I think what people are sort of a lot of hand wringing right now is sort of the type. Number one is that the youth unemployment is basically at a 11-year high, excluding, or 12-year high. I can't do math, excluding the pandemic. So that's really important. But also, it's the type of temporary work, and so Dr. Mike Moffat will sort of delve into his views on this. And by the way, this is not Monday morning quarterbacking. If you follow him on Twitter, he's a great follow. He's been talking about this for almost a decade, and it's funny how as the political winds blow one way, he's like a traitor, and now he's leading the cause. And really, I think he's been very consistent in his language and his views on this, and that's why it'll be really interesting to have him. But like we said last week, I think it's not the agriculture piece, because the agriculture is obviously very seasonal, especially in Canada, and that number has been relatively flat, as we discussed in the Globe Mail article that I think did a really, really good job. I think the real issue people are having now is the supposed low wage, low skill stuff, and how a lot of these big companies, and I'm sure some small companies too, are just, I mean, how do I say that? I mean, they're just basically scamming the system. Let's not beat around the bush. And so we've seen the temporary foreign workers basically explode for those low wage, low skill, forgive the name, over the last 2 years. And I think that that's really the issue.
So, Rich, there was a government commissioned investigation that recently completed in May. It wasn't released to the public, but this is from Bloomberg. It found a significant increase in fraud and abuse in the temporary foreign worker program, with newcomers being charged anywhere from 10,000 Canadian dollars to 180,000 for jobs. And so, yeah, I mean, for an immigration system that was once considered sort of the envy of the world, it's now being sort of quoted by the UN as basically a modern slavery program. And of course, this is adding to the issues that we're also seeing in the foreign students, which are coming to all these sort of fake colleges atop the Burger King joints that are giving these crappy diplomas, charging people an arm and a leg, with, again, hopes that these jobs might transition to a legitimate salary or legitimate career and then fast track them to permanent residency. But in reality, now you've had 1.2 million people a year coming to this country and adding strains to housing. There's nowhere to house them. So, you've got these foreign workers and foreign students, 20 of them living in basements in Brampton. And so it's just been a mess. Of course, we see the strains on hospitals, on other infrastructure. So this is kind of like all encompassing, right? I mean, when you talk about immigration, and you talk about housing, and you talk about the lack of productivity and, GDP per capita, I mean, this is all tied into basically the same equation.
I have a question. So first, I think it's good for everyone to understand that it's not Steve using the word slavery. This is actually from the UN.
Yeah, that
So
was a
it's
quote, direct quote.
yeah, direct quote, absolutely. And then you have Bloomberg, another major news source. They're following the story as well. I think a lot of people in Canada are unaware that people are actually paying money to come into Canada, such as this, 10,000 or 120,000, whatever the number is, to sort of squeak in. 'Cause I think most people would think, oh yeah, immigration is happening because people want to leave where they are because things aren't that good for them, and they line up, they complete a form, and they come in through the arrival gate at the airport. But can we share a bit more how this is actually working? So who's charging the 10K or the 120K? I assume this is a very small industry and their margins are pretty good. It sounds like. Obviously, it's not regulated at all. So I think it's important that this is now coming to light. But what else can you share with us, Rich, that
Yeah,
you
let me just
perceive?
read a little snippet from the Bloomberg article, because I think it kind of helps summarize. I'm sure there's people that are listening to this podcast might not be experts or perhaps overly familiar with all the immigration programs that are available for people to come to the country. So basically, we have this like black market emerging for temporary foreign workers that are basically, people are recruiting on Facebook, WhatsApp, Instagram, TikTok, and they're advertising basically these pre-approved limas, and limas basically just one sort of program that they can come through. So basically, for foreigners who aspire to move to Canada, the incentive to purchase a job is straightforward: get one backed by a LMIA lima, boosting applicants' chances of winning permanent residency. The main immigration pathway is called the express entry, and it ranks applicants by their likelihood to succeed economically based on a points system. As the minimum qualifying score has risen, a Lima job offer goes a long way by itself. It can be worth more points than working a full year in Canada. So basically, these temporary work permits tie the newcomer to one employer, which makes it challenging to switch jobs in the case of abuse or exploitation, and leaves the individual stranded if the offer is revoked. And so we're just seeing basically a lot of these companies taking advantage of this. You have these third party consultants that sort of set them up with these companies, and basically just charging them egregious sums to get them into these Lima programs so they can kind of get fast tracked to ultimately the end goal for all of these people coming here is to get permanent residency in Canada, which of course, if you track, the federal government only sets target on permanent residency. So there's no targets for like, foreign students and all this. So I might have butchered some of that, but that's kind of the gist of it.
Well, can I just jump in with some sort of like where I think for me it really hurt, like when I read these articles, again, it was a Bloomberg article, they said, I'm just going to read it because I think it's just amazing. So Navdeep Singh, a 39-year-old accountant in India, arrived in Canada through a program. He invested everything in this dream to move his family, he and his wife, a teacher, drained their savings and borrowed money from friends and relatives to scrape together more than $40,000. The sum, which receipts so he paid WWICS Group, an immigration consultancy with offices in Ontario, blah, blah, blah. He said he was fired within days without a real explanation, and he effectively had to go home because he didn't have sort of the job that it was promised to him. I mean, there's a real cost to this incompetence at the federal level and for at the provincial level too. Let's not leave those guys without blame. And I think that's the stuff that really, when I read that stuff, it just really breaks my heart. And it's just, these programs are clearly ripe for exploitation and abuse, and we're seeing it.
So are there any, because then like if we had, Mark Miller on here now and said, hey, are you aware of this? He would, I'm assuming he's going to say, yeah, we are very aware of this. And someone in that group, they may also say, hey, no laws are being broken. It's just a lot of, very shady, dodgy characters doing this. But I mean, obviously now this is becoming more public, three babbling turds are talking about it. what is the solution? Like, how do we make this better for these individuals? Like I think Mr. Singh, I think you referenced then, Rich, that was his
Yeah.
name. Moving, 40 grand from his own savings and borrowed from family and friends, move his family to Canada. Is there a way to make this better?
I mean, I think my first off the cuff is I think all these the temporary worker program is one way to do it. I mean, outside of some very very specific industries, I don't think they should exist. It just should not exist. I mean, we read the list of what falls under what is appropriate. Cashiers, you know, working at a Tim Hortons. I'm sorry, you do not need a temporary foreign worker for that. So just doing away with that, pure and simple. I think
But
just an audit.
maybe, but maybe does this represent, 5% of the temporary workers that are coming in, or is it
It's a large
20,
number.
40?
It almost jumped up to it's almost as many as the agribusiness in the agriculture.
So just on Tim Hortons there, again, kind of Twitter's going kind of crazy on them. People are saying, boycott Tim Hortons. It's interesting. So Tim Hortons in Ontario, Tim Hortons has hired at least 714 temporary foreign workers last year, compared to just 58. So 714 temporary foreign workers last year compared to just 58 in 2019. So, however, 92% of those jobs in 2023 were listed under holding companies that didn't use the Tim Hortons name. So, I don't know. I mean, I'm a Timmy's guy. I mean, I like, still go for the coffee and the donut. I think it's deeply entrenched in Canadian culture, but clearly they are one of the
but
they
Keith,
they are abusing this program.
I want to challenge that because we were running at a run rate for almost 50 years, about 320 to 350, 375,000 people a year. And clearly there was a shock to the system. There was an opening of the gate. So, we could say, how do we improve this? But the reality is like once you just philosophically decide you want to triple that number, the reality, it just opens it up for abuse, right? Because you're like you're implicitly saying we're just going to check less. We're going to, we are just allowing more people for this to happen. And so what the market signal that you're sending to the people that we've, discussed and that's discussed in the article is that, it's just easier for it to happen. And so where there was no possibility to run a business, you're saying now there is. And so it just becomes more ripe for abuse. Do you know what I mean? If a third of the volume was coming in, there would just be less opportunity, I think, to or have less opportunity to abuse those loopholes. That's, I think, at a minimum.
I'll just give you a quick example, and the details, are not perfect because I'm kind of recollecting the conversation I had 6 or 7 weeks ago with somebody that works sort of in an HR company. And so basically, the conversation he had was he was sort of directly familiar with a situation, for example, where this guy comes in from India, temporary foreign worker. So he gets approved for this work visa, whatever. He paid, I think it was $50,000 for it. And so now he gets employed as a special sort of. He's basically a bricklayer. They're saying he's a bricklayer for this construction company. The construction company isn't really employing him. Yes, like there's pay stubs being given out, but he's required under the table. He pays back his whole salary to this third party consultant, and then they send the money back, right, to the company that paid him. And so he's not actually laying bricks. He is driving Uber Eats.
Oh my God.
So that's like, and again, this is just like one example, but I think there's probably a lot of these stories out there where, again, you pay for this sort of work permit so you can hopefully get fast track for PR, but you're really not working for that company. You pay this third party consultant that's involved under the table illegally. And so there's just a lot of fraud. There's a lot of, abuse of the system. I think that who do you blame, right? I mean, I think there's a lot of blame to go around, but I think at the end of the day, I mean, you hate to say it, but it does fall under the feds. I mean, like it happened under your watch, and so I think there has to be a level of responsibility that is taken here. Rich, one of the solutions appears to be is that they're now changing the permanent residency program to basically allow what they call essentially is what level 4, level 5 workers. So these people that are on these temporary foreign workers like cashiers and stuff are going to be basically automatically omitted into the PR program.
And what is that?
So
Are those are tier 4 and tier 5? Are those the highly educated people or uneducated people, or what skills do they have?
yeah, so it's funny. They actually like just kind of changed their website. So tier 4 and tier 5, it's basically, yeah, it's low skilled. It's like equivalent to like a high school diploma. So no post secondary education. Um, so the permanent residency program is designed to bring in highly skilled people that you can't necessarily have Canadians that can fill those jobs, right?
Yeah.
And so those might be highly skilled construction workers or things of that nature, people in the tech space. But I guess what they're doing here is they feel bad and saying, okay, well, these people kind of got ripped off, scammed, and so we don't want to leave a bad taste in their mouth. So why don't we just include them, lump them in, expand the PR program to allow these people to sort of come in and get permanent residency. So they're going to include these low skilled Tim Hortons cashiers, I suppose. And again, I don't think we have all the details here, but this is just a new program that was announced. I'm sure Mike Moffat will give us more details on it. I know friend of the show, Ben Rabideau, has been all over it. So kudos to him as well.
What a mess. I mean, I'm kind of speechless, really, from a bottom up perspective. What were you thinking, Rich?
I just want to add a couple of things, and then Keith, maybe this will add, which is so the criticism is if you import lots of low skill, low wage workers, it displaces sort of the working class, whereas sort of high skilled laborers or people who have high education are much more difficult to displace. I think in the interest of balance, I think it's really important that people are aware that there's loads of economists, smart people, listeners of the show who texted me who argue that you could make a case that that's not necessarily true. I was reading an article from the RBA, the Reserve Bank of Australia. The Bank of England has lots of work on this. There's the Cato Institute, which is a bit of a right-wing nut job place, but still pretty good. The Brookings Institute, which has had authors such as Ben Bernanke and Yellen write significant papers for them. And they argue that that very much depends on a substitution effect. And there's a real argument that some really smart economists make. I don't agree with it, but it's important that people know that low skilled immigration can allow domestic born people to actually expand, to jump up the jump up the labor value added curve, let's say. And so I'll just read you quickly what they said. It says, for example, low skilled immigration laborers allow, in this case, US born, but I think it can be applied to Canada, farmers, contractors, and craftsmen to expand agricultural production or to build more homes, thereby expanding employment possibilities and incomes for US workers. And all the literature is very much about the substitution effect of those low wage and low skilled laborers. Meaning, if there is no cohort that is easily substitutable, then it's a net positive for your economy. And if there is, then it's a net drag on those laborers. That's the balanced argument. I find it quite dubious, but it's important to people know that there are lots of researchers out there that don't necessarily agree with Mike Moffat or myself or you, Steve, or Ben Rabideau.
So just to chime in here and to kind of wrap it up. But remember, I think we talked about this last week. In 2014, heading into the 2015 elections, Trudeau put an op-ed out that said the conservative he basically eviscerated the conservative government for allowing the temporary worker program to become, quote, a broken system that, quote, oppresses wages for all Canadians, and he promised to scale that back, right? And so we've seen the mess that it has become under his watch, and this is a guy that clearly was against this, and I'm sure he's, as someone that, you know, I'm sure he's not the kind of guy that loves to see the UN saying this program looks like modern slavery. I suspect he probably doesn't want that on his resume. But so yeah, we'll see how this plays out. I think Rich, the thing that I find most fascinating about this is how it's all tied in, right? So it's like you have all this like rampant fraudulent immigration coming into the country, which has put all these like strains on the housing market, particularly on shelter prices in the rental market, which has then prompted CPI inflation to be otherwise a lot higher than it needs to be, which has prompted interest rates to move up a lot higher, which has which has prompted all now we're seeing is real estate insolvencies
Keep going.
as interest rates have pushed higher and higher and higher. It's now causing real estate insolvencies across the board. So Canada right now is on track for about 240 real estate insolvencies this year per the Globe and Mail. That will be higher than in 2009 after the global financial crisis. And this doesn't include the plethora of projects that have been forced into receivership. And so if you're not familiar with kind of the difference between an insolvency and receivership, there's some nuances there. So basically, if you're like the lender, so let's just say you lent this developer a whole bunch of money. So insolvency is when basically the developer puts his hand up and says, I'm screwed. I'm just going to declare bankruptcy, and I'm going to basically relinquish my assets and get out of this thing. Receivership is when the lender says, hey, I want my money back. And they appoint a receiver, a person to start going in and selling off those assets via court order. So they're different. So there's a lot of receiverships, and we don't calculate. There's no data set for receiverships, but like anyone that's paying attention in the industry knows that receiverships are very common, and they are booming right now. So coming full circle, we can see how this is all kind of playing out. Of course, due to the housing crisis, we then created the Housing Accelerator Fund, which is basically passing all of these municipalities. We've been stroking checks with municipalities to release and lighten up on their zoning requirements. What they've done is then lighten up the zoning, but then they've offset that by raising government taxes and fees on these developments, making them effectively economically unviable. And so housing starts and permits are going to continue to roll over the next 24 months. That is a lock. That is a guarantee. Now, there's not much on this show that I'll guarantee, but housing permits and starts are going to roll over hard over the next 24 months.
So are you saying this started in 2014 with a little butterfly moving his wings?
It's amazing though to see like all the whole pieces when you put them all together and see like everything is connected. And so like, because people are like, well, this is like, why are you guys talking about immigration? This is a macro podcast. And it's like, well, the big picture here is this is all interconnected.
Sorry to interrupt the show. A quick message from our sponsors. Ever been lost abroad searching for Wi-Fi and all you found was frustration? Introducing Saily eSIM, the ultimate travel companion brought to you by Nord Security. With Saily, you can avoid outrageous roaming costs, compatible with both iOS and Android. Saily is so easy to set up. First, download the Saily app and install your eSIM with a simple tap. It's quick, easy, and hassle-free. Next, choose a plan that suits your travel itinerary, whether you're off to London, Mexico City, or visiting Rich's family in Portugal. Saily has a plan for over 150 countries, and with a variety of options, you can find the best rate that match your needs and the duration of your trip. Activate the eSIM before you travel and connect instantly when you land. No internet required. This ensures you're ready to go as soon as you arrive. With Saily, you stay connected wherever you are, cut those fees, and enjoy 24/7 chat support. No more waiting in airport lines or dealing with sketchy SIM card sellers. Just download once and you're good to go. So easy, even the boomer can do it. Go to Saily.com/LoonieHour and use the code LoonieHour to get an exclusive 15% off your first purchase. Link in the description below. And now, back to the show.
Okay, well, it's a real mess here. Even if there was a change with policymakers this week, some hard decisions have to be made. But this trend that has started, and as we I've been talking about it for a while now. Let's sort of come back now to an economic financial market perspective. The trend that started is that economic growth has peaked. And in Canada, while it's still looking positive on an absolute basis, on a per capita basis, as a per person, which includes, the whole population, of course, we continue to see a declining trend across a number of metrics. And I think we'll be going a little bit more like we're seeing that continue in China, for example, in Europe. The Americans still have some, depending on which data point you're looking at, the same thing.
I think a lot of our core themes are really playing out. We're seeing them happen in real time, and this is, we were relatively early with thanks to some of our friends on the immigration side, on the housing side, Keith on the US side, right? I mean, you guys in particular have been suggesting that the US is still the cleanest dirty shirt, and the data, while it has certainly weakened and softened materially, it's really not that bad. And I think that was kind of backed up today. You were tweeting out on retail sales and some of the other data that came out this week.
Did I tweet that or did I DM it? I get them mixed up sometimes.
I think you tweeted it.
I did a tweet.
I've been too negative on the US. That's my mea culpa there. I've been far too negative on the US.
Have you though? I feel like you were kind of like you were kind of in like the no cuts camp.
Yeah, I mean, that's part of. I mean, I think maybe I've let my personal view on what I think real interest rates should be cloud my judgment on what I think the market is going to happen and what will happen. Maybe if I could admit some guilt there. I think I've
just to be clear, all of Rich's views going forward have to be identical to mine. So
oh, Keith.
Oh boy.
I hope you're not serious about that.
No. But one sort of, funny twist that, I know I've been saying it quite a bit, referencing communism, commies, socialism, and stuff like that. Because we are in a capitalistic society and economy. That's where we are. It rewards risk taking when it's profitable, and you get penalized when it isn't. We are headed for a cycle now that's going to flush out a lot of bad decisions. And a lot of the bad decisions are done by the private sector, a lot of other bad decisions by the public sector. And unfortunately, it has to happen. So some people say, oh, you're being negative on this or that. No, it's not being negative at all. It's just recognizing where the cycle is and where it's going from an optimistic perspective, from an insensitive investment manager perspective. When we get a flushing out of the system that's coming out, that's where you have opportunity coming along here. And like Steve and Rich, what you're sharing earlier with the population story in Canada, again, I'm not seeing anything that says this is all getting a whole lot better here right now. And the negative story in Canada, face it, when the UN starts calling out Canada and using the word modern day slavery in the title, then that ain't a good thing that's going on. But from an equally negative good thing, we also have that happening in other markets as well. So again, was it the Monty Python song? Was it Rich? Look on the bright side of life.
Yeah, always look on the bright side of life. Yeah.
Yeah. So we just got to look a little bit further, and we got a bit of a dip coming up, before then.
So Keith, you want to walk us through some of these retail sales that are maybe supporting, like, I mean, like, I think here's what's happening, right? Is we've talked about, some of the data that has been softening recently. And so, now the markets are pricing in concerns about recession, how many rate cuts we're going to get. And so there's the August Bank of America Global Fund Manager Survey. So it's 189 managers, over $500 billion of assets under management. So it's just a good way to sort of see how these people are thinking and positioning. I guess you can call it, how is the consensus sort of looking at markets today? And so right now, recession is the number one tail risk, according to global fund managers. The percentage of managers that think monetary policy is too too restrictive has jumped dramatically this month. It's the highest it's been in 16 years. 93% of them think short rates will be lower in a year, the highest percentage in 23 years. And 60% of global fund managers expect at least 4 Fed rate cuts over the next 12 months. So, I think, Keith, safe to say that, yeah, consensus is fairly aggressive rate cuts, recession in the U.S. And so I'm curious if you kind of share that view.
Yeah, well, it's been our narrative that markets were always pricing. This goes back to last summer, so a year ago when they had the Fed meeting at Jackson Hole in Wyoming. Like back then, the market was always waiting for the Fed. When are they going to cut? When are they going to cut? And it's been dragged out for a really long time. Now they are the last central bank who hasn't cut, and the next meeting is coming up in a few weeks, and there's a 100% probability that they'll cut. So if you want to sucker Rich into another Twinkie bet, let's not share with him what the
I'm ready.
probability is.
I'm
You're ready
ready.
to go. There you go. But so what's going to happen next? Once we do get through this euphoria that, hey, now even the Fed is cutting rates, because the market believes, hey, if you cut rates, that's awesome for the world. It heals everything. Then all of a sudden, we're going to start looking at, is a recession actually happening? Is a slowdown happening? So you're looking at, top line aggregate data. You're looking at bottom up, for example. You want to, hey, it's Walmart. Walmart had really good numbers this morning, I think.
Yep.
And, Walmart sells to the, lower household income levels. So when times get tough, people, they trade down instead of shopping at what's above
Whole
Walmart?
Foods.
Target, or you move from Whole Foods, down to, whatever, Albertsons maybe, or whatever they have down in the US for the Americans. But we're going to start to see that happen now. Looking through, is a recession happening? We talked before about, you want to watch the quarterly bank earnings and see what they're provisioning. If we do have a recession up here in Canada, the banks, there's no way they're even close to having enough provisioning done. So that's going to accelerate. But with let's just real quick this morning, like yesterday, we had CPI data that came out. And in our world, like Rich, we'd say it was kind of dovish, right? Like it wasn't super strong. So it was suggesting, hey, inflation is continuing to slow. It's not coming down, like it's slowing. And then today, all of a sudden, we had retail sales and import-export prices, and it was jaw-dropping. Every single data point was greater than expectations, which implies the local economy is still really strong. And I'm sure some people will pick out 1 or 2 points and say, well, that doesn't say it's strong or that say it's weak. Overall, this was a very hawkish data print this morning. And then you also had import prices and export prices, and they're all stronger. Revisions from the previous month were sort of made stronger as well. So this morning, euro is getting mullered. Japanese yen, they're now back to the carry trade is now full on again. Yeah. So Canadian dollar sort of flattish. It's a bit weird. But that's where we are now, Steve. So now this is one of the last data points coming out before the Jackson Hole speeches. And so it's always a little something there. So let's just go to that real quick before then you want to talk, Richard, you want to comment then on the data points. But the Jackson Hole speech is coming up now in August 22nd to the 24th. That's where the Federal Reserve, they host a nice, casual, slow moving conference for central bankers around the world. So, the Canadians will be there as well. It's kind of funny. It seemed like there's only one place in the whole mountain range to get your photo taken, and they all go to the same place. You know what I mean? With the fence and then the mountain behind it. You'll know what I mean.
I don't know.
You'll see it. You know what I mean. But traditionally, any speeches there, they're very casual, very folksy and short. 5 minutes, 10 minutes, maybe 20 minutes. And they are rarely used to express a point of any kind. It's more like, word salad, central bank stuff, right? And I can see Rich's interest just got piqued, of course, with that comment.
Well, I want to go
But
skiing there.
yeah, skiing there in August isn't that awesome. But
No.
yeah. But real quick, it was 2 years ago that Powell, that's when he lost his shit. He said, "Hey, we are still incredibly hawkish with monetary policy in the US." And he came out with the mic dropping moment, right? He just came out and said, "We're not cutting rates, we're raising rates," something like that. Uh, right now, because the markets are fully expecting the Fed to cut by not only 25, it could be even 50 next month. I don't think that will happen. But if for some reason the Fed wanted to temper expectations, then this is when they'll do it. My expectation is they won't. I think it'll be as snoozy as anything. But this could be the last opportunity for the summer if the Fed they want to do something. And very quickly, right now market is expecting possibly 75 basis points being cut over the next two meetings. I say possibly, it's not quite 75, it's around 65, 68 if you look at it. But Mark is expecting, hey, they're going to start cutting rates, and a full 100 basis points cut by year end. And then for the Bank of Canada, this is the great one as well. Guess how many, the next four meetings, guess what the rate cut expectations are?
2%.
Anyone?
No, wait. The next four
No,
meetings?
yeah.
Is it 5 cuts? So 125 bips?
Close, four.
Four.
So,
Okay. So
yeah, so
25, 25 at each meeting.
yeah. So Loonie hour math, 25 times four,
100.
Drum roll.
125 apparently. The but again, like the expectation is to be very aggressive, which I think sort of ties back to Steve, what you were just sharing with us there before we started this part of the conversation about market expectations and everything. So it seems now we've swung to, hey, central banks are going to start cutting rates everywhere. And we've often said that if central banks are cutting this aggressively, maybe that's not good. Do you know what I mean? Because there has to be something else happening underneath.
So just to confirm, you said the markets are currently pricing 75 from the Fed by year end
No, possibly almost 100.
for the Fed.
Yeah. Yeah.
Wow.
And the
Yeah.
Bank of Canada.
I mean, the Bank of Canada seems a bit more obvious, but
Um,
the Fed is, that'd be aggressive.
My only thing I want to add on the CPI and the Fed and Jackson Hole and all the rest of that is to highlight that one of the sort of data points that came out with the CPI is that core services X rent of shelter, which is Steve's favorite component, is still like 4.75, almost 5%. And yes, it did come down. It's still incredibly high and well above the target of 2%. I mean, the big drag, just to remind everybody, has been core goods, and core goods is way down year on year. It's minus 1%, almost. Core goods we saw, it was negative 2.3%. So you have services which remains high even if you exclude rent or of shelter, and you have core goods which has collapsed. And I think that I just, the idea that the Fed is just going to immediately to follow that trajectory, even though employment is still relatively okay, I just find kind of hard to believe. I guess we'll see.
hey, Steve, just to clarify, I don't want to have any confusion here from a Looney Hour podcast. God knows we've never done that before, have we? For the Bank of Canada, everyone, it's the market is expecting 75 basis point in cuts at year end, and then another 25 at the January meeting. So you get the four meetings. Yeah, to be 100. I mean, just an observation from my side. Again, like I was sort of referencing earlier, the commies, and socialism and everything. And this is a very correct, accurate view because it is my view, right, Rich?
Yes, your view is
Yes.
100% accurate.
Taking notes. Just remind everyone, after the American housing market crashed, we went a full decade with almost the entire world at 0% rates, negative or near zero, and QE galore and unlimited, you name it. The Europeans created so many different alphabetic acronym bailout programs for everyone. Same with the Americans and everything. And then all of a sudden we go, like in Canada, we went from what, 3.5% overnight rates pre-pandemic to zero very, very quickly. And then we went from zero after we were told they would never raise rates again, from 0 to 5% very quickly. And now the market is expecting to go from 5 down to 4, 3, 2, 1, and everything is okay with that. It is not okay to have that much volatility, because when rates are moving up and down that fast, that has to be a cleansing of the system somewhere. The expectation that just moving that lever up and down, that's going to protect everyone and everything from having a true price discovery. I'll take the other side of that in the marketplace. So I think we are due for some real, mark to market in a number of different markets, whether it's housing world, equities, currencies, credit, you name it. But don't you find though, everyone's become so complacent now, Steve, with everything? They just feel, yeah, we're okay for a few months. But again, no one has experienced this kind of a disruption with the pricing of money in such a short time frame that's been condensed, with debt just accumulating beyond belief, with policymakers saying, yeah, don't worry, we got this.
You're talking about complacency to the housing guy. I mean, the amount of complacency in Canadian housing, particularly Toronto, Vancouver, over the last decade plus has been fascinating. I mean,
it's worked.
Yeah,
loads of people have gotten very rich.
It's true. It's kind of like just close your eyes and hit the buy button. But yeah, I mean, the complacency is amazing, right? I mean, there's like nobody that felt rates could go from 0 or 1 to 5, right? I mean, yeah, people.
I did.
Well, for sure, but you know what I mean, right? I just
no,
think
I'm teasing.
I even look at
so did our CIBC guys. Remember, they were the ones who got it right.
Well, I mean, I've been getting into spats with people on Twitter here in the last couple of days about tenancy laws in BC, because those tenancy laws were never designed. All of these policies that were brought in were designed in low interest rate environments. They were designed in low inflation environments, and they were designed in highly liquid markets. And I'm not going to go on because this will take up too much of the show, but it's amazing to see all the policies that now people are like, uh-oh, what do we do now?
There's one more thing I just wanted to add on as far as Canada and the US, and it's something I've been mulling over, so forgive me sort of, working through it with you guys. But what's different about this cycle coming up is that we already have huge deficits in the United States, and there isn't you don't have the tailwind of the massive COVID injection of cash to people, the massive savings that they can draw down on. And you also don't have the ability for a generation of homeowners in the US to remortgage up from 7 or 6 down to 3 and 4s. And so I think that if you do have a situation where unemployment does start to go up, and remember, it's not linear. Once it starts to creep higher, it'll jump higher. Same in Canada. That there's no reserve to fall back on. And when you do, and it's going to be very difficult for America specifically who's already running a massive, massive budget deficit, to increase its budget deficit even higher to sort of be a counter-cyclical thrust as far as to save demand. And I think that's shaking up to be, I think, a risk that I don't think people are really thinking about. We're already starting to see the 30-year mortgage rate in America start to fall. It's at 650 now, and yet mortgage application rates haven't responded. Housing starts in America haven't responded. New home sales haven't responded. And so it'll be interesting if we do sort of, slowly like sleepwalk into this recession in America and in Canada. I don't think you have as much cushion or policy options from the fiscal standpoint to help the economy along, which might make it a sharper and nastier recession than I think people are sort of pricing in.
I mean, I think it's almost somewhat similar on the housing side here in Canada, right? I mean, you've seen mortgage rates at one point, I think it was what is it, last fall or something. Anyway, it was at one point they reached like 6.2, 6.3. We're kind of about 4.7 today for a lot of mortgages. And it hasn't really restarted activity. And so,
Yeah.
if it goes from 4.7 to 4, is that going to be enough to sustain like a new bull market, or help the average consumer? Because I think most people would still be renewing their mortgages coming off of a 2.5% rate and renewing at 4.
Yeah.
So, it might be enough to give the market a sugar jolt before it kind of fades out again. I don't know. It'd be interesting to see. I mean, of course, the three of us are just pontificating here, but
I think it was just two of you, actually. I didn't say anything on that.
Keith, any final notes here? I know you're keeping an eye on the Chinese bond market. We had our guest, Michael Nicoletos, come on a few weeks and talk about his concerns about what's happening in China. There was a really good article in the Financial Times about the Chinese bond market. I don't know if you want to walk us through that.
Yeah, I mean, if you remember a few weeks ago when we had the guest on, it was all a discussion about how China, get ready, this is brand new, an over-levered economy. That's what it is. It's the same here in Canada and the Americans and everyone else. But because they have this closed capital account, so it's difficult to get your money out. You can put your money in the Hotel California, you can't get it out. And we continue to see data points to suggest or confirm that the economy, it is grinding lower. I don't think you can grind quickly, right? Maybe we'll see. But
Grind higher.
no, it's going lower. The economy is weakening. But this article that came out from the Financial Times that you were just referencing, it talked about how in the local Chinese bond market, bond yields are going lower and lower and lower. And if that's happening, that means that local money is rotating into the bond market because you want safety and liquidity in that domestic market. And that in itself is suggesting, hey, a recession is either it's already there or it's coming. But from a plain, simple perspective, it means, hey, people don't want to invest their money, right? They'd rather hold a government bond instead of buying another real estate property or investing in some manufacturing plant or something like that. So the overall theme with all this, if you have a slowing economy, it becomes very deflationary.
And the
So
Chinese
if
government is trying to enact policy right now to arrest basically bond yields from moving lower, correct?
yeah, but they don't want them to go too high either. They're really, Japan is now completely screwed. For 54 hours they had that crazy moment. They said we're going to raise rates. They went from 10 basis points to 25 basis points, and that not only did it rock Japan, but it rocked the world. The whole world felt this, of course, in financial markets. And then, as Rich pointed out, they came out and said, "Oh well, my bad. We're going to do over." And they
Just
announced,
kidding.
actually, yeah, just kidding. That was your word, yeah. And they said, well, we're likely we'll never raise rates again. So now the carry trade is starting to come on again. And that's the same thing with Japan. So we keep going back to the point that losses have to be recognized in the system because people say, well, how do we avoid a recession? How do we make things better going forward? And the way you do that is that losses need to be recognized. You have to allow them to come true. Like death has to happen, like for some companies and government and markets. And then, it's even better, when we get going. But again, though, like Japan is bad. China is bad. The UN says Canada is not going down the right path at all with some things. The Americans, will they ever resolve, depending on who wins the election, will that resolve the deficit in the US?
No,
No,
definitely not.
it's
Neither
impossible.
neither party will run a budget surplus. Here's a guarantee for you, Steve.
Yeah. I mean, I don't know if people realize this, but in the US, they have mandatory government spending.
Yeah.
So it's defense spending and then their social welfare account, whatever you want to call it. That is always greater than tax revenues.
Is that right?
Yes, it's impossible for these guys to get back. And people might remember, yeah, Bill Clinton ran a surplus back in 99, 2000 or '01 or something. And the only way they did that was because they shifted all of their borrowings to short term. So their interest expense went from, 5 or 6% down to 1. So that had a nice sugar rush for about 2 or 3 years. And then you got to renew again, right, Rich?
Good reason
Steve?
for the Fed to start cutting.
It's going to be something coming up here. It's real
It's
interesting to watch.
almost. So in 2023, mandatory spending was 3.8 trillion and total revenues was 4.4 trillion. So almost, I'm looking at the Congressional Budget Office website right now. That's crazy.
It's real tough.
It's 90%.
What their interest expenses are greater than their military expenses.
Yeah,
now.
for the first time since I can't remember what year, the 80s or the 90s.
Well, it's a slippery slope. So yeah, I mean, it's a good place to wrap it up. We maybe a little early. I'll drop a little early snippet preview. We're planning a Loonie Hour live social in Ottawa. We're going to go to the nation's capital in September, mid-September, date to be determined. But the Loonie Hour will be in Ottawa. There's a special guest that might be joining, Bob Sacamano. We're still working on some of those details, but
I'd love to talk to him.
It's gonna be fun, and we're also gonna do like the sidewalk interviews, walk around and interview some of the locals in Ottawa to get their feeling.
Ask them what they think about the dear leader.
I love the dear leader. He is great. He is great and wise.
Great. Keep us up in the YouTube algos.
That's right.
All right. I think it's a good place to end it. As always, we appreciate the support, and we'll see you next week.